Somewhere in America right now, there's a guy named Marcus sitting at his kitchen table with his laptop open. He's 34 years old, he has a 401k through work, he owns a simple S&P 500 fund, a target date retirement fund, and maybe a few random stocks he bought during the last bull market because the internet made them sound impossible to lose money on. He is not a professional investor. He does not read IPO filings for fun. He does not know what float adjusted market capitalization means. But this week, he saw one headline over and over again: SpaceX, biggest IPO, record valuation, Elon Musk, rockets, Starlink, Mars. And suddenly, Marcus, who ignored his 401k for 6 months, is staring at his retirement account thinking, wait, am I supposed to buy this? That one question is where the trap begins, because SpaceX is not just another stock story. It is the kind of company that makes normal investing rules feel boring. It has rockets landing upright. It has satellites covering the planet. It has government contracts, global internet dreams, space missions, and a founder who can move markets with one sentence. So when a company like that finally becomes available to everyday investors, people don't look at it like a stock. They look at it like a once-in-a-generation ticket. And tickets are dangerous, because tickets make you think about what could happen if everything goes right. Investing requires you to ask what happens if it doesn't. My name is Edwin, and welcome to The Wealth Shift. And if you are watching the SpaceX IPO thinking, should I buy this before everyone else gets rich? This video is for you. Because the biggest trap in this IPO is not that SpaceX is a bad company. That is too simple. The real trap is that SpaceX might be an incredible company and still become a dangerous investment for beginners at the wrong price, in the wrong size, at the wrong time, inside the wrong mindset. Let me explain. SpaceX reportedly priced its IPO at $135 per share, raising around $75 billion and valuing the company near $1.75 trillion before trading even began. Then the stock opened stronger, climbed on its first day, and pushed the company's market value past $2 trillion. Stop and think about that. Not $20 billion, not $200 billion, $2 trillion. That puts SpaceX in the same conversation as the largest public companies on Earth almost immediately. And this is where beginner investors get emotionally cornered. Because your brain hears biggest IPO ever and translates it into biggest opportunity ever. But those are not the same thing. A big IPO means the company is raising a lot of money. It does not automatically mean you, buying after the hype, are getting a bargain. That difference matters. A great business can be a terrible investment if the price already assumes perfection. Imagine someone offers you a beautiful house, perfect location, great neighborhood, strong foundation. Everything about it is impressive. But then they ask you to pay 5 times what every similar house is worth. The house did not become bad. The deal became bad. Stocks work the same way. The company can be real. The mission can be real. The technology can be real. The excitement can be justified. And the stock can still be priced so aggressively that normal investors are buying years of future success up front. That is the first trap. The story is easier to understand than the valuation. Most people understand rockets. They understand satellites. They understand Elon Musk. They understand the dream of being early. What they do not understand is how much future growth has already been baked into a $1 trillion price tag. And Wall Street loves that gap. Because when a company has a powerful enough story, the numbers start feeling rude. You'll hear people say, "You don't understand. This is the future." Maybe, but the future still has to become revenue. Revenue still has to become profit. profit still has to justify the price, and the price still matters to the investor buying today. That's the part people skip. They don't ask, what return do I need from here? They ask, do I believe in SpaceX? That is not investing. That is brand loyalty wearing a brokerage account. Now let's talk about your 401k, because this is where things get even more interesting. Most people think a 401k is something boring in the background. You contribute money, your employer maybe matches it, it goes into an index fund or a target date fund, then decades pass, and hopefully future you is less stressed. But when a company like SpaceX becomes public, the question changes. If SpaceX becomes large enough, liquid enough, and eligible for major indexes, your retirement account may eventually own it, whether you personally press the buy button or not. That's how passive investing works. You buy the index owns the companies. When the index changes, your money follows. And this is why the SpaceX IPO is bigger than one stock. It can change the ingredients inside the funds millions of people already own. If SpaceX enters a major index, funds tracking that index may have to buy it. Not because the fund manager loves rockets, not because they believe in Mars, because the rules tell them to. That is why some investors are watching the index story so closely. NASDAQ has created a faster pathway for very large new public companies to enter the NASDAQ 100 under certain conditions. The S&P 500 has been more cautious and has not simply said, "You're huge, come in immediately." That difference matters because a NASDAQ-heavy fund and an S&P 500 fund may behave differently if mega IPOs keep entering the market. And Marcus, sitting at his kitchen table, probably does not know any of this. He just knows his retirement fund went up or down. That's the second trap. You may think you are choosing not to buy SpaceX, but depending on what funds you own later, you might still become exposed to it automatically. Now, that does not mean index funds are bad. Index funds are still one of the best tools normal people have. But it does mean you should understand what you own. Because I own the market sounds simple until the market starts becoming more concentrated in a few massive names. And this is where the third trap shows up. The "I'll just buy a little" trap. This one sounds harmless. A beginner says, "I'm not going crazy. I'll just put a few $100s into SpaceX." And maybe that is fine. A small position that you understand, that fits inside a bigger plan, is not the end of the world. The problem is that beginners rarely stay honest about a little. First, it is $300. Then the stock goes up. Then they wish they bought more. Then they add $1,000. Then it dips. Then they add more because now it is on sale. Then suddenly a stock they barely understand becomes 20% of their portfolio. Not because they planned it, because emotion kept moving the line. That is how concentration risk sneaks in. It does not kick the door down. It politely asks for just a little and slowly takes over the room. And the bigger the story, the easier it is to justify. With SpaceX, the story is enormous. Space internet, government launches, reusable rockets, defense, moon missions, Mars, future industries that may not even exist yet. That makes the upside feel infinite. But infinite upside stories are exactly where discipline matters most. Because when the dream is massive, people stop asking basic questions. How much of my portfolio is this? What price am I paying? What would make me sell? What if the stock drops 40% after I buy? What if the business succeeds, but the stock goes nowhere for years because the valuation was already too high? That last one is important. A company can grow, and the stock can still disappoint. This happens more often than beginners think. If investors price a company as if it will become perfect, then perfection becomes the starting line. Good is not enough. Great is not enough. It has to beat the dream people already paid for. That is a brutal game. And that brings us to the fourth trap: IPO excitement. IPOs are psychologically designed to make you feel late before the race has even started. The company was private for years. Insiders had access. Early investors had access. Employees had access. Big institutions had access. Then, finally, the public gets access. And the public thinks, finally, my turn. But you have to ask a very uncomfortable question. If you are buying from someone, why are they selling? That does not mean they are wrong to sell. Early investors may need liquidity. Employees may want to diversify. The company may need capital. There are perfectly normal reasons shares become available. But the point is simple. An IPO is not a gift. It is a transaction. Someone is selling ownership at a price they are willing to accept. You are buying it at a price you hope is still attractive. Both sides cannot be getting the better deal for the same reason. And during a hot IPO, the buyer's biggest enemy is often not Wall Street. It is their own fear of missing out. FOMO makes people buy first and think later. It turns, I should research this, into, what if it doubles without me? It turns a portfolio plan into a lottery ticket. And the worst part is that sometimes FOMO gets rewarded in the short term. The stock pops. People post screenshots. Everyone who waited feels stupid. Then the real test begins. Because the first few days of an IPO are not the same as the next 5 years. Early trading can be driven by limited supply, excitement, headlines, options, momentum, and people chasing the story. Long-term returns come from business results catching up to the price. Those are different games, and beginners often confuse them. They see a first-day pop and think it confirms the investment. No, it confirms demand. Demand can be powerful. Demand can also be temporary. So what should a normal investor actually do? First, separate the company from the stock. You can admire SpaceX and still not buy at any price. You can believe reusable rockets are amazing and still keep your portfolio boring. You can think Starlink is important and still refuse to let one stock control your retirement. That is not being negative. That is being an investor. Second, check whether you already have exposure. If you own broad market funds, tech-heavy funds, NASDAQ funds, aerospace funds, innovation ETFs, or target date funds, look at the holdings over time. You may eventually own more SpaceX than you realize without buying individual shares. Third, decide your rules before emotion shows up. If you want to own individual stocks, set a limit. Maybe no single stock above 5% of your portfolio. Maybe speculative positions stay under 1% or 2%. The exact number is personal. The important part is deciding before the stock starts moving like a roller coaster. Because once the price is flying, your brain will negotiate against you. Fourth, do not use money you need soon. Not rent money, not emergency fund money, not credit card debt money, not money meant for a car repair, medical bill, or taxes. A hot IPO is not a substitute for a financial foundation. If you have high interest debt and no emergency fund, the SpaceX IPO is not your first move. Your first move is boring. Cash buffer, debt payoff, paycheck system, retirement match, low-cost diversified investing. Then, after the foundation is built, you can decide whether a small individual stock position belongs in your plan. That order matters. Because the market is full of people trying to become rich before they become stable. And that is how exciting opportunities become expensive mistakes. Now, let's go back to Marcus. He is still at the kitchen table. The headline is still there. SpaceX is still exciting. The rockets are still landing. The dream is still enormous. But now he asks a better question. Not, will SpaceX change the world? Maybe it will. The better question is, what role should this stock play in my actual financial life? That question is less exciting. It also saves people. Because your job as a beginner investor is not to catch every historic IPO. It is to build a portfolio that can survive your emotions. A portfolio that does not depend on one company, one founder, one headline, one launch, one government contract, one hype cycle, or one perfect future. That is why boring diversification keeps winning. Not because it has the best story, because it does not require you to predict which story becomes true. A broad index fund does not ask you to know whether SpaceX, Nvidia, Apple, Amazon, or the next company you have never heard of will dominate the future. It simply owns the field. And when the winners change, the index changes with them. That is the quiet power of boring. It does not trend. It does not make you feel like a genius at dinner. It does not give you a screenshot worth posting. But it protects you from needing to be right about one spectacular company at one spectacular price. So here's the shift. Do not ask, is SpaceX going up? Nobody knows that with certainty. Ask, if I buy this and I am wrong, does my financial life still work? If the answer is no, you are not investing. You are gambling with a space helmet on. If the answer is yes, because your emergency fund is built, your debt is controlled, your retirement contributions are automated, your index funds are the foundation, and this is only a small position you can emotionally handle, then you are at least thinking like an investor. That is the difference. The SpaceX IPO may create winners. It may create regret. It may enter indexes. It may reshape portfolios. It may become one of the biggest investing stories of the decade. But none of that changes the basic rule. A great story is not a financial plan. A famous company is not automatic wealth. And the future being exciting does not mean you should overpay for it today. So before you buy the headline, check the foundation. Before you chase the rocket, check the portfolio. Before you ask whether SpaceX can go to Mars, ask whether your money can survive Monday. Because the investors who last are usually not the ones who get most excited. They are the ones who stay disciplined when everyone else forgets that price still matters. Shift your money, shift your future.